I'm Motley Fool Canada Senior Analyst Nick Seipel, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're discussing Enbridge's business and its dividend. My guest today is Motley Fool Canada Chief Investment Officer Iain Butler. Iain, thanks for joining me.
Great to be here, Nick. First 5 minute major of 2025. Let's go.
Pipeline giant Enbridge is one of the widest owned companies in Canada, and it's a company we get asked about all the time. The stock has had a pretty good run if you look at the last 12 months with its TSX listing up over 30%. However, if you zoom out, the stock itself is up just 15% over the last decade. That's without dividends. Even if you include dividends, which it does have a healthy dividend payout, it's lagged the return of the S&P TSX Composite Index by 30 percentage points. Iain, when you look at Enbridge today, what do you think of the opportunity the stock presents to investors?
For sure. So maybe we'll just do a quick summary of what Enbridge is, and then we'll get into the potential returns available. So Enbridge is made up of four components. It's got a liquids pipeline division. That's the biggest. About 50% of the company is related to carrying crude oil and natural gas liquids across North America. Super extensive system. And so 50% of the business is crude oil transport. Gas transmission and midstream, that's related to natural gas transportation. That's about 25% of the company. Gas distribution and storage. So Enbridge serves Ontario and Quebec residents with their natural gas. And that's another 25% or another 22%, sorry. And then renewable energy is about 3% of energy of Enbridge's asset base. So that's a quick summary. And then when we get into the meat and potatoes here, we can think about Enbridge stock return in three different components. Let's talk about company growth, change in the company's multiple, and then the aforementioned dividend yield. So when we think about company growth, this is a pretty staid business. So when we look back over the past decade, we can get a pretty good sense that the decade ahead is going to look similar. So Enbridge has grown its cash flow per share at about 7% annually over the past decade. So we can plug that figure in as our company growth figure. Multiple on that cash flow over the past decade, it's ranged between 6 and 12 times. Currently, it's just over 9 times cash flow, and pretty tough to argue that there should be multiple expansion baked into this equation. So we're not going to give it any credit for multiple expansion. And then the dividend yield. Currently, Enbridge yields about 6%. So there's a formula here. Company growth moves ahead sort of 7% annually. And then a dividend yield of about 6%. There's a scenario here where Enbridge could indeed provide a return, an annualized return over 10% per year for the decade ahead, and that's pretty good, especially when we consider the Canadian market typically moves ahead on average 6 to 8% annually. So we potentially got a market beating situation on our hands should everything go in our favor, and this one should be a company that you sleep pretty well owning as well.
Yeah, if you look back at Enbridge, you talk about the maybe not the most dynamic company in the world, but certainly a reliable dividend payer. That's been a large portion of the total return. If you look back over the past 10 years today, has a healthy 6% dividend yield. How do you think about the sustainability of that payout over the long term and maybe the prospects too for that to increase for income investors?
Yeah, so I mean, Enbridge has been a bond. Had you bought the stock 10 years ago, you've owned a bond. The bulk of your return has been that income stream. So income is very important to this story, and that's frankly the area of concern that I have with this situation. The company generates a pile of cash. If we take a cumulative number over the past 5 years, it's generated about $54 billion in cumulative operating cash flow. However, it's a very capital intense business, both in terms of expansion and maintenance needs. So capital expenditures over that period of time have amounted to $28 billion. And then those dividends add up. The company has paid out $35 billion in dividends over the past 5 years. So we've got $54 billion of cash flow against $28 billion in capex and $35 billion in dividends. That leaves us with a $9 billion shortfall. Enbridge has been short $9 billion to cover those capex and dividend commitments over the past 5 years cumulatively. So that money's got to come from somewhere, and in this case, it comes from debt. This Enbridge is constantly adding to its pile of debt, and it's a formula that's worked. It's always played this game. The company has always played this game, and it's fine as long as people are willing to lend to it. But my fear is that at some point, the market just says no more. You can't manage the amount of debt that you have on your books, and that's when debt gets very expensive, and bad things can happen to a company's shareholders in that kind of situation. So it's likely that nothing goes wrong here, but this is the scenario that I could see Enbridge shareholders sort of losing quite significantly. Should the company's lenders draw a line in the sand?
Yeah, so we're looking here at a company that's produced a bond-like return, but we have some questions about whether those coupons can maybe be maintained if the company continues on its current trajectory. Maybe the market will help them out. We'll continue watching to see if that happens. Until then, Iain, thanks for joining us for this edition of the 5 Minute Major. Hope to see you next time.